Credit card debt consolidation. Credit cards can be powerful credit-building tools or sources of uncontrollable debt if they're not managed correctly. When debt starts to snowball, the solution could include consolidating it. But you do have some debt consolidation options. Debt consolidation is when you combine multiple balances, making the debt easier to deal with. First, you have fewer monthly payments, and maybe even just one. Second, you can potentially have lower interest rates after consolidation, costing you less in the long run. Your options for consolidation depend on the size of your debt, how much you earn, and what credit score range you fall into. Making a credit card balance transfer is one of the most common and popular methods. This involves moving your outstanding balance from one or more cards to a new or different card. Ideally, you're going from a high-interest card to a lower-interest card and working with a higher credit limit so you can fit more of your debt onto that card. But this can be challenging if you're already buried in debt with maxed-out cards. At that point, it could be difficult to qualify for a new high-limit card, especially with a low interest rate like a 0% APR. Also, applying for a new card is a hard inquiry, which could lower your credit score. The next option is applying for a debt consolidation loan. This is like a balance transfer, but using an installment loan instead of more revolving credit. Your loan pays the balances on as many credit cards as possible. Covering more than one credit card balance still reduces the number of monthly payments. It likely has a lower interest rate than your credit cards, and it might be easier to qualify for since it's a different type of credit, but it's still a hard pull, which may impact your credit score. If you don't qualify, consider taking out a secured loan. These require some sort of collateral to back the loan. If you own a house, you can look at a home equity loan or home equity line of credit, HELOC. These provide funds borrowed against your home's value, either as an installment loan or revolving line of credit. But you could lose your house if you don't make your payments. If you have a retirement account like a 401k or 403b, you may be able to take a loan from that account. You're typically allowed to borrow up to 50% of your vested account balance, which you pay back through payroll deductions over a term of up to 5 years. The interest rate is usually lower than a personal loan, and you're paying the interest to yourself. But you lose some tax benefits because you contributed pre-tax dollars, then pay back after-tax dollars. Using a credit counseling service might be a good idea if your debt is overwhelming. This is different from aggressive debt settlement services, and it's best to look for an accredited nonprofit. But not everyone qualifies, and this may negatively impact your credit score in the short term. If all else fails, consider asking a loved one for help. It's an informal agreement, so you can set your own terms and renegotiate if needed. But borrowing money from a friend or relative could go badly if you don't pay it back. So here's the bottom line. Consolidating debt is usually a good thing, but how you get there requires some thought. Only you can decide what works best for your personal situation.